FHA loans are a fantastic option if you're looking to buy a home. In this video, I'm going to show you every single thing that you need to know. There's going to be timestamps along the bottom. That way you'll be able to understand what an FHA loan is. Should you get it? Is it the best loan for you? And by the end of this video, I promise you'll know more about FHA loans than a lot of loan officers. So let's talk about some highlights. Why in the world would you look at FHA to begin with? Number one, this is one of the easiest loans to qualify for, mainly because it allows a high debt to income ratio and has really flexible credit requirements. So debt to income is the formulas lenders use to determine the maximum loan amount that you can get. So if you have a debt, you have like credit cards, student loans, auto loans, things like that, and it feels like I'll never be able to afford a home or I'll never be able to get approved for a mortgage, FHA is often a really good option because it has that high flexibility. Also, credit, it is more flexible than other loan types. So loans like conventional tend to like higher credit scores, where FHA will go down to a 500 credit score with a 10% down payment. But if you have a 580 credit score, it's 3.5% down. Now, hear me out really quickly. Just because you have a 500 score doesn't mean you're immediately going to be able to get a loan. Really, FHA is best 580 and above. Anything below 580 does become extremely difficult, okay? Also, this is not just for first-time buyers. People think that this is just like a first-time buyer loan, which is not true at all. Anyone can get this. Okay, let's first talk about the minimum down payment by the credit score. So compared to other different loans, FHA is a little bit different because your minimum down payment that you have to pay is going to be dependent on what your credit score is. Okay, so for instance, a lot of people think that 20% is what they need to buy a house. It's just simply not true. So if you have a 580 credit score and above, then the minimum down payment you need to make is 3.5%. So for example, on a $425,000 home, that is a down payment of $14,875. Now, if your credit score is 500 to 579, you're going to need to make a 10% down payment, which is going to be $42,500 for that same priced home. Now, with FHA and most other loan types, you can always put more down than the minimum. However, as home prices continue to increase, most people are looking at those minimum down payments for something like an FHA loan. Also, FHA loans can be cheaper than conventional loans, especially for buyers with lower credit. So often with an FHA, and I'll talk about this in an upcoming slide, is you get lower rates often with FHA because it's backed by the government. All right, so some really quick pros and cons here is that this is one of the easiest loan types to qualify for. You're also going to have lower interest rates, low down payment, and then also low mortgage insurance than often conventional if you have lower credit. So we'll talk about mortgage insurance upcoming, but a lot of people think that conventional is always a better option. But in a lot of cases, even though FHA has that mortgage insurance, I'll walk through the math with you on it all, but FHA often has lower mortgage insurance monthly than a conventional loan does. Also, it allows for rehab financing, and it's great for first-time investors with multi-units, where you can actually live in one unit, rent out the others, and still purchase that home with only 3.5% down and collect that rental income while you're living there. Now, some big cons here with FHA, because it's not all amazing, is that it does have stricter appraisal requirements than other loans like a conventional loan. So those stricter requirements can make it difficult to purchase a home that needs some rehab work, and it's not always a loan that's preferred by sellers. Something else is that FHA has upfront mortgage insurance premium. And again, I'll cover this in an upcoming slide, but basically you have monthly mortgage insurance, but then there's also an upfront mortgage insurance that's usually included in the loan amount. And so that's something to keep in mind. And then loan limits may be lower in high cost areas. So if you're looking at maxing out, the price that you're purchasing a home in your area, you may run into some issues there because FHA has loan limits that are lower than a conventional loan. So what is an FHA loan? An FHA loan is insured by the Federal Housing Administration. It's the FHA, but it's offered by many lenders. Okay, so FHA does not lend money. It insures payments to investors. So you can't directly go to FHA and say, hey, can you get me a loan? Basically, what the FHA does is they're going to insure those loans so that tons of lenders throughout the US can give out FHA loans. Most lenders do FHA loans. We do FHA loans as well. We work in 49 states. If you want to get a pre-approval, it's at winthehouseyoulove.com. But FHA is really common. It's one of the most common loans that you can get. Also, lenders have what are called overlays, meaning they can set their own additional requirements beyond FHA minimums. So what we're talking about in this video is the FHA minimums. So FHA gives their guidelines for the loans that they, here's all the requirements. And so most lenders follow those. Some lenders have overlays saying they mean, they make the requirements a little bit more strict. So they might say our minimum credit score is 580 versus the FHA 500. So it's something to be mindful of. So if you're new here, my name is Kyle Seagraves. I'm a licensed loan officer with NFM Lending. Our team is licensed in all states except for New York. So if you're looking at an FHA or you're just saying, hey, I don't even know what I can get approved for, can you help me out? We can help you figure out what's the best loan for you and give you a quote so you can see how much of a house you can get approved for. Then you can go out shopping with a realtor to find the home that you want. And so a pre-approval is free at winthehouseyoulove.com. If you like these videos, you're going to love working with our team. Everyone on our team has the heart of a teacher and is going to be with you every step of the process. Okay, let's talk about down payment assistance. So FHA are the most common types of loans with down payment assistance. And so down payment assistance, mainly what it's doing is it's just helping you with that, let's say that 3.5% down. Maybe that's too much. And so down payment assistance often is a second loan added on top of the FHA loan. So it's giving you a second loan for the down payment. And usually this is going to come with a higher rate, but it can help you get into a home. So I wouldn't say be afraid of down payment assistance because it definitely can help you get into a home, find a place that your rent isn't going to keep increasing and you can actually say, hey, this is mine, and you have ownership of it. However, DPA does come with some downsides with that higher rate. Okay, it can also be slower to get, and there can be other restrictions with it. So from a purely financial point of view, getting down payment assistance usually isn't the best financial option compared to using your own down payment. However, if it's something that you need to do to be able to get into a home, it's an option that you have available. So one of the down payment assistance loans that we have is called the NFM Flex. And so this is a zero down FHA loan. So what happens here is you get a second loan that covers 3.5% to 5% down as a second loan. And then what ends up happening is that second loan has around a 10-year term. So there's a couple different options, but 10-year tends to be the best. There's no income restrictions. It allows you to buy a 1 to 2 unit home, and the minimum credit score is a 660 to get that type of option. Now, keep in mind when it says zero down doesn't mean that it's going to be free to buy your home. That's not what that means. It means that the down payment is covered, but with every loan, even if you're buying a home in cash, you're going to have closing costs. And closing costs are going to be around 2 to 4% of the purchase price. And closing costs are things like paying for your home appraisal. There's going to be a title insurance, a title search. There's going to be recording fees, possibly transfer taxes in your state, property taxes, homeowners insurance. Those are closing costs you're going to run into with every lender, with every loan. Even if you're buying in cash, you're going to have closing costs, something you need to keep in mind. And I'll show you how you can get the seller to actually pay some of those closing costs. So closing costs are the biggest thing that people misunderstand about getting a home. Because most of the time, when you hear about loans, people are often just seeing the down payment. Hey, the down payment on a conventional is 3%, or USDA is a 0% down, FHA is 3.5% down. But people forget about closing costs. Okay, so again, closing costs are going to be required on every single loan, and for all the other fees that are required for you to purchase that home. Some of those biggest expenses are things like a title search, title insurance, and then also property taxes as well. So closing costs on FHA are similar to other loans with one big difference here, and that is FHA's upfront mortgage insurance premium. Okay, so I'll explain that in an upcoming slide about the mortgage insurance, but that FHA insurance is going to be added into your loan amount. So it's not going to be something that you pay up front, but it will be included in your loan amount. So you can actually ask the seller to pay for some or all of the closing costs. So what you can do is ask for up to 6% of the purchase price to be covered by seller credits. So this is something that happens when you're making an offer. So you can talk with a realtor and say, hey, I talked to my loan officer. I need the seller to cover a little bit of my closing costs because maybe that's too much for me to make on my own or for me to pay on my own. And so what you'll do is negotiate with the seller to say, hey, we'll make an offer on your home. Maybe it's $300,000, and we're going to ask for 3% of seller credits. So it doesn't have to be that full 6%, because keep in mind, the higher that you ask for seller credits, that's less money coming out of the seller's pocket. And so that makes your offer less competitive to the seller. So for example, let's talk about a $425,000 home. Let's go through what this would look like in general. So let's say that the down payment that we're doing is 3.5%. So that's a $14,875 down payment. Now, let's say our closing costs, we're just going to roughly estimate at $6,500. Okay. If we ask the seller for a 1% credit, we're going to take 1% of the purchase price of the home. That's $4,250. That means the total due at closing would be $17,125. So we added the down payment, closing costs, subtracted the credit. Now we have that total due that we would need to bring to closing to be able to buy this home. Keep in mind here that seller credits can make your offer less attractive in competitive markets. So it's nice to get that seller credit. However, you don't want to go overboard with it, especially if you're in, multiple offer situation or your market's really hot, because the seller is going to look at that and say, why would we give all this money when someone is asking for no credits over here? So just keep that in mind and talk with your agent about that. Okay, so we talked about your down payment and closing costs. Now what happens is your lender actually has to prove that you have that money. It's a requirement of all loans. You can't just say, hey, I'm good for it, I have the money, no worries. That doesn't really work in the mortgage world. So what has to happen is the lender has to be able to document that you have that money before you buy the home. And so this usually happens with 60 days of bank statements. Okay, so you'll send bank statements to your lender, or we even have technology where you can log into your bank through a secure portal and it pulls all that in, so you don't have to worry about it at all. Now, in those bank statements, the lender is also looking at any large non-payroll deposits that are over 50% of your monthly income. So those have to be sourced. Okay, it just means it has to be documented. There has to be some sort of paper trail there. So for instance, if you had a ton of cash and you just deposit it into your bank account, that doesn't really work. A lender has to know where in the world did that money come from, and cash just often doesn't work. So what you can do is you can use things like collateralized loans, for example, like a 401k loan. That's perfectly fine to use. However, you can't use things like unsecured loans. So credit cards, personal loans, things like that won't work. So what a lender is looking for when they're seeing those large deposits, they want to see that they come from an acceptable source. So these can be things like savings from your work, down payment assistance. This can also come from a family or from your family or from a loan program. Any gift funds. So a family member can both give you a loan for the down payment, but they also can give you just a flat out gift for the down payment or closing cost. Crypto must be liquidated and held in account for 60 days. So you can't use your Bitcoin for the down payment. Cash on hand technically can be used in the guidelines, but most lenders have overlays saying that that doesn't work. So if you ever run into a situation where you have this money, let's say that you have $5,000 cash on hand, some people do, and you deposit that into your account and you're like, I want to buy a house. Okay, well, that deposit won't work. So what will end up happening is the underwriter will say, we have to basically back that out. It's what it's called. Back it out of your assets. So nothing happens to your real money, but the lender's saying we can't use that money to prove that you have the ability to pay for the down payment and closing costs. However, the way that the seasoning trick works is if you keep money in your account for 2 months, since the underwriter only needs to see the past 60 days, they won't see anything before the 60-day period. So if you have cash, if you have a large deposit to make, you want to put that in your account now, then apply for a loan. That way you have a 2-month period before you're actually looking at buying a house. That way that money doesn't get flagged and gets backed out of the available funds that you have to purchase a home. Okay, now let's talk about the credit score and your FHA approval. Now, everybody has, or most people have, 3 credit scores. You're going to have one from Equifax, one from Experian, and one from TransUnion. And so when you're getting a mortgage, a lender is going to pull a tri-merge credit report. So they're going to see all 3. And then they're going to take the median one. So they're going to look at the highest one. So in this instance, it's the 690 from TransUnion, and they're going to X that out. Then they're going to look at the lowest one, which would be the 673 here. And so 680 would be used for the score on your mortgage. So that's going to determine what rate you get and also how easy it is for you to get an approval. So they're using that median score. So with credit score brackets, let's talk about a couple different differences with different credit scores. Okay, so first, a 500 credit score. This is the minimum requirement for FHA. And again, this is going to have a 10% down. Now keep in mind, again, just because this is the minimum doesn't mean it's going to be easy to get approved. Having below a 580 makes it extremely difficult to get an FHA loan, and most lenders won't do these types of loans. If you have a 580, that's the more widely accepted version of FHA, and that allows you to do 3.5% down as a minimum. 640 is going to be approved by most lenders, so that's where you're going to see anything below 640. It's a little bit touch and go, but above 640, you have really good odds of getting that FHA loan. 680, you're going to get even better interest rates. 700 is where FHA might not be the best option, and you want to look at a conventional loan as well. So even if you have above a 700, what I would suggest is that you look at both conventional and FHA and see which one is a better fit, because for some people, conventional is better, for some people, FHA is better, even with high credit scores. A lot of people think that FHA is just for people with low credit and bad credit. It's just not true, especially because of the low mortgage insurance and the low interest rate with FHA. It often can be a better option than a lot of conventional loans. Now, I also want to reiterate the big overlay problem with FHA, and then frankly, a lot of mortgages, is that not all lenders follow the bare minimum FHA guidelines. Okay, some lenders add stricter rules that are called overlays. So just because you meet FHA's basic requirements doesn't mean that every single lender will approve you. Also keep in mind that just because you follow the basic requirements here doesn't mean it's an automatic approval, because mortgage approvals are based on what's called an automated underwriting system. It's basically like a software with an algorithm that determines if your loan is too risky or not. And so these are the base requirements, but ultimately that system is the thing that determines if you can get a mortgage or not. All right, let's see how this works in the real world with a real life home and some example numbers here. So this is a home in Dayton, Ohio, listed for $379,000. Let's talk about the monthly payment here. Okay, so principal and interest, we're gonna bring around $2,342 per month. And just a quick note, this is all based on average interest rates here in the US at the time of recording of this video. Mortgage insurance is going to be $167. So the mortgage insurance is what protects the lender. That's the FHA insurance. Basically what it's doing is that if you don't pay back this mortgage, that money is there to give, basically protect the lender so that they don't lose money if you don't pay the mortgage back. So that's what that is there. Property taxes, $493. Yes, property taxes in Ohio are expensive. Homeowners insurance estimated around $140 per month. No HOA fees on this property. So for this home, you'd be looking at around $3,142 per month as an estimated monthly payment on this type of home. Now, the cash to close, what's a little bit confusing is cash to close is the word used in the mortgage world for how much money do you owe when you buy the house. But again, you can't use cash. It's stupid, but that's the word that's used in the mortgage world. So 3.5% down, $13,265. Estimated closing costs, we're going to put around $7,580 as an estimate. This market is not super hot, so we can ask for a seller credit. We're going to ask for 1%, which would give us a $3,790 credit, meaning that the total due at closing to buy this home would be $17,055. So this is a good example of a home that's slightly below the median home price in the US and give you a really nice rough estimate of what it would look like to buy a home with this loan. Again, keep in mind, this is all public data. Costs and payments are just based on averages. This is just for educational purposes. This is not an offer to you specifically to lend. These are not offers that we're making to you. If you want a custom quote for a property and want to get approved for a loan, you can go to winthehouseyoulove.com. All right, let's go through another example here. I accidentally messed this up. This is in Phoenix, Arizona, not Orange, California, but this is listed for $425,000. So let's go through the monthly payment here. You'd be looking at $2,626. The mortgage insurance on this would be $187 per month. Property taxes, $89. Homeowners insurance, $168,000. No HOA. So that would be $3,070 as a monthly payment on this. The down payment, 3.5%, would be $14,875. Estimated closing costs around $8,000. In this market, it looks to be a little bit more competitive, so asking a seller credit probably isn't the best move. So total cash due at closing would be estimated around just below $23,000 to buy this home. in Phoenix with an FHA loan. Now, FHA has loan limits, so you can't go above those. FHA loan limits are set at 65% of the conventional loan limit. So if you're running into this issue where FHA is just a little bit too low of a loan amount as the limit, you can always look at a conventional loan to get a higher loan amount there. The base loan limit in 2024 was $498,257. In 2025, that one unit loan limit now is $524,225. And you can see if you get a 2-unit, 3-unit, and 4-unit, that obviously increases the max loan limit that you can have. Also, the loan limits increase in high cost areas for more expensive housing markets. So these are going to be the base loan limits that you're going to find in most of the US. However, I'll have a link in the description to look up different counties. So if you're in a high cost of living area, you might have a higher loan limit that you can get. All right, so let's talk about the interest rates. FHA interest rates are going to be typically lower than conventional loan rates. That's because they're insured and backed by the federal government. So they're less risky to lenders because they have that mortgage insurance. They're backed by the government, meaning you're going to get a lower rate than conventional. They're government insured, so that lowers the risk for lenders. Also, they have reduced risk compensates for required mortgage insurance costs. So what a lot of people have issues with FHA is that it has that upfront mortgage insurance and the monthly mortgage insurance. However, even though you have that, you're getting a lower interest rate than a conventional loan. So that lower rate offsets often that upfront cost that's baked into the loan amount with FHA. And I'll do a whole comparison to kind of show you the mathematical differences between the two. You can also get a fixed loan and an ARM. Oops. So with FHA, you can get a fixed rate or an adjustable rate mortgage. Really just depends on your risk tolerance. Most people are going to get a fixed rate FHA loan versus an adjustable rate mortgage because that obviously can change with the market versus if it's fixed, that interest rate is never going to change over the duration of your loan. Also with FHA, it's easier than conventional to get lender credits if you want to. So there's a trick that you can do with most loans where you actually ask the lender to give you a higher interest rate, and in return, they'll give you a lender credit to help offset your closing costs. Now, this is easier to do on FHA than it is with conventional. So if you need that credit, FHA might be a better option so you can get those lender credits. So let's look at an example of what these rate differences can look like. You can go to winthehouseyoulove.com/rates to see the national average rates. Okay, so for instance, conforming, 30-year conforming, this is a conventional loan. Right now, the national average is 6.657. On an FHA loan, that would be 6.348. So you can see about a 0.3% difference in the interest rate on FHA being better than the average conventional loan. All right, so FHA mortgage insurance. This is the dreaded thing that everyone's so afraid of. So on a conventional loan, there's what's called PMI, it's private mortgage insurance. On FHA, it's called MIP, it's mortgage insurance premium. They just flip around some of the words a little bit. Basically what this does, it protects the lender if you default. That's what FHA does. What's also kind of cool about FHA is that it's fully self-sufficient from the MIP funds. So it doesn't have to it doesn't have to rely on the federal government to fund FHA. It's all self-sufficient within itself. So that's really nice. So HUD funds FHA programs via the mortgage insurance. It's what pays to allow FHA to exist. So every FHA loan is going to have two types of mortgage insurance. You have the upfront mortgage insurance premium, that's the UFMIP, and then you also have the MIP, the mortgage insurance premium. So upfront is one-time fee included in the loan amount, and then mortgage insurance premium is paid monthly. So before we jump into some of these facts, let's look at the numbers here. This upfront mortgage insurance premium is going to be 1.75% of the loan amount. Okay, now the mortgage insurance premium, this is going to be 0.55% of the loan balance. That's going to be the annual number. And then we divide that by 12 to get the monthly amount that's paid here. If you do a higher down payment or a shorter loan than 30 years, that number can change. But for most people, if you're doing a 30-year loan with 3.5% down, it's going to be 0.55% of the loan balance. So for instance, on a $300,000 loan, that's $136 per month. Now, some things you want to keep in mind with mortgage insurance on FHA is that it's going to last for the life of the loan unless you put 10% down. If you put 10% down on an FHA mortgage, the mortgage insurance is going to drop off after 11 years. Compare that to conventional loans mortgage insurance lasts until you have 20% equity in the home. As soon as you have 20% equity in the home on a conventional loan, mortgage insurance falls off. However, with FHA, if you're doing less than 10% down, it stays on for the life of the loan, no matter how much equity you have. Also, what a lot of people forget is the mortgage insurance premium decreases each year as you pay down the loan. So you're going to start off with, for example, in our example, $136 per month. However, next year it's going to be slightly cheaper. The year after that, slightly cheaper. It goes down as the loan gets paid down. And again, FHA loans may be cheaper than conventional in a lot of instances because of lower rates, and you can get an easier approval than you can with a conventional loan. So again, I know people are so afraid of mortgage insurance on FHA loans, but because you have that lower rate, it's often a great deal compared to conventional. And that 0.55% mortgage insurance is often lower than conventional loans, especially if you have, let's say, like a 640 score. You're probably going to have a higher rate of mortgage insurance on a conventional loan than you would on an FHA loan. Okay, so let's talk about an example using some real math. If you want to use the calculator that I built, it's whenthehouseyoulove.com/advisor. It helps you compare different loans side by side. So what we're going to do in this scenario here is we're going to take a look at, let's say, a $450,000 home. And what we're going to compare is conventional versus FHA. So I'm just going to label them conventional, FHA. We chose the loan type here. The difference, with 3% down versus 3.5% down. We're at 30-year loan length. I'm putting in that average interest rate, that's 6.657 versus FHA average 6.348. And you can see here what's happening is the monthly mortgage insurance is input for conventional, and then FHA is automatically being calculated. So what ends up happening is if we look through the different years, during the first 5 years, conventional is the better option. But then if we scroll out to the average time that somebody is in a home, 10 years, FHA is the better option by $5,000. So what this calculator is showing is it's actually including, finance mortgage insurance. That's an upfront mortgage insurance premium. Conventional has $0. FHA is going to be just below $7,600. Monthly mortgage insurance, you can see FHA or conventional is a little bit higher than FHA on average. The interest also is lower on FHA, right? And we're not counting in lender fees and points on here because we just want to compare the raw loans side by side. So I really just want to show you this because even if we scroll out over here, you can see that, once we get to year 22, if you're in the home for 22 years and never refinance, conventional is going to be better by $380. And then if you zoom out here, there's never the biggest difference that you'll see here is when we get to year 11, FHA is $6,400. Okay. So the main reason I want to illustrate this is because so many people are afraid of FHA and it's going to be so expensive and the mortgage insurance is crazy. But in a lot of cases, like we're showing here, if you're in the home for the average period of time, FHA is actually mathematically a better option. And you can compare these numbers too in the calculator as well. Talk to your loan officer and say, hey, can I have a quote for conventional and a quote for FHA? Put them in here and see which is a better option for you mathematically. So many people are afraid of FHA loans, but if you actually do the numbers on them and not just the random anecdotes that people say, you see what is the better option for you because so many people, I hear realtors do this all the time. FHA is so much money, you should go conventional no matter what. It's just simply not true. In a lot of cases, FHA is a better option for you mathematically. The problem is people just don't spend the time and energy to actually run the math. And so that's why I built this calculator is it has in all the guidelines. It understands all the loan programs, all the differences. It keeps mortgage insurance on for FHA. It removes it for conventional once it gets 20% equity. All that is factored in here. It took me so much time, but all that's factored in here so you can make the right choice on the loan that you want to get. So again, that's at whenthehouseyoulove.com/advisor if you want to use that calculator. Okay, now let's talk about credit issues that you might have and how FHA is going to handle those. So first, know that medical collections no longer show up on your credit report. Okay, so the CFPB has ruled that medical collections won't show up so that if you have those, it's going to be easier for you to get approved for a loan compared to when those were on a credit report. Also, CAVERS reports need to be cleared. So there's this system called CAVERS, and basically it's the federal government system for monitoring if you're behind on any federal debt. So if you have IRS liens, federal student loans that you're behind on, you won't be able to get an FHA loan if you're on that CAVERS report. And so every lender is going to run this for you to see if you're going to get be eligible for an FHA loan. So it's something you need to be mindful of. If you have federal debt that's delinquent, then you need to talk with your loan officer about that because it has to be cleared up before you can get an FHA approval. So if you had a deed in lieu of foreclosure or a short sale, you have to wait 3 years from that transfer to be able to be eligible for FHA. If you had a Chapter 7 bankruptcy, it's 2 years from the discharge. Chapter 13 bankruptcy, you need 12 on-time payments and a court approval. Or if you're going through like the automated underwriting system, it's 2 years from discharge. So basically, if you only have 12 months of on-time payments, it's possible to get FHA, but it can be more difficult. And then if you have IRS liens, you need 3 on-time payments, and that monthly payment is going to be included in your debt to income ratio. Okay, student loans. A lot of people feel like if they have student loans, it's going to be impossible for them to get approved for a mortgage. It's simply not true. Student loans often aren't an issue for most people getting a mortgage. And FHA actually allows you to use an income-driven repayment plan when you're getting a mortgage. So the biggest issue that people have with student loans is that monthly payment for your student loan has to be included in your debt to income ratio. So that's going to change the amount of loan that you can qualify for. But if you're on these IDR plans, then FHA will allow you to use that. So they have rules that say that if the payment is $0 a month or deferred, the lender has to include 0.5% of the loan balance in the debt to income ratio. Okay, so that's the really big issue here with FHA, is that if it's $0 per month, then we have to basically assume what that payment is going to be. However, if you have an income-driven repayment plan that's even just $1, we can use that in the debt to income ratio. So for example, let's say you had a $50,000 loan balance. If it was deferred or it's $0 a month right now, then we would have to use $250 a month in your debt to income ratio. So that would effectively lower the maximum loan amount that you can get qualified for. Now, for some people, that's not an issue, but for others, you might run into that issue and need to go onto an IDR program. That way, that helps your debt to income ratio have a little bit more breathing room for your mortgage approval. Now, if deferment prevents that approval, you can enroll in a government repayment plan to avoid that 0.5% rule. Okay, so now let's talk about underwriting. Underwriting is the thing that people are afraid of most when it comes to getting a mortgage. And underwriting is basically are you going to get a thumbs up or a thumbs down for your loan getting approved? So there's 2 different types of underwriting. There's automated, which is the most common, and there's also manual underwriting, which requires a little bit more documentation. It also comes with a higher rate, and it's a slower process. Not all lenders do manual. Most of the time, you're going to run into automated underwriting. This is also referred to as AUS, so the automated underwriting system. And so the way that AUS works is step 1 is it's a software review. So you're going to submit a loan application. So that application data is analyzed by a software. Okay. And those algorithms aren't always like super well known. They're not published. It's think of it like Instagram. No one really knows what the Instagram algorithm is, but we have a general understanding of how it works. Very similar to loans. We have a general understanding of what's going to get approved and not, but a loan officer can't just look at an application and say, you're good to go with an FHA loan. They can say it looks like it, but we still have to run it through the software to see if it's actually going to get an approval. Then step 2 is your loan officer is going to review all the details of your application to get accuracy. So they take your application, run it through the software. If the software gives a thumbs up, that's when they're going to make sure, okay, does the application match real life data? So if you say your income was $6,000 a month, we need documentation to show that you actually make $6,000 per month. That way we can prove that everything is accurate and that the automated underwriting system approval is going to stick. So this is the general order a lot of loan officers are going to run through. First, they're going to go through automated underwriting system. Okay, that's the most favorable option. It's the easiest one. You're going to get a lower rate if you have AUS compared to a manual underwrite. So if from there, you don't get if you get a thumbs up immediately, that's great, you're good to go. If from there, the underwriting system doesn't give you an approval, then with FHA, you can actually add on rental history. So if you're a first-time buyer with a 620 credit score and higher, and you can prove 12 months of on-time payments, then rental history can be added to your approval to kind of nudge it in the right direction. So from there, if it still is giving you a no, like it doesn't actually give a thumbs down, but your loan officer will tell you if you're not getting approval there. From there, another option can be adding a co-borrower on the loan. So if you have someone who's willing to be on the loan with you, that can help improve the strength of your application to hopefully nudge an approval. From there, if that doesn't work, that's where you kind of want to go back to the drawing board and see, okay, maybe you need to work on your credit profile a little bit more to be stronger, to make it easier to get that approval. And then from there is where we might look at manual underwriting. It's usually seen as kind of a last resort. If you aren't getting approved through AUS. And the reason why is because manual underwriting comes with more risk, more documentation, and then also it's just a more expensive loan. The rate is going to be higher with manual underwriting because it's more risky to the lender. So manual underwriting, I'm not going to go through every single thing in here, but basically lenders look at charts like this. So they would see, okay, let's say your credit score is here, and these are the debt to income ratios that they want to target. There's compensating factors that they need to have along with it. And so you can see where there's a lot of extra requirements depending on your credit score and then how much of a loan you're getting for all of the other requirements that they're going to need to get your loan approved. Now, underwriters, when you're getting an FHA loan, are looking for stable employment history. And the general rule of thumb is that you want a 2-year stable employment history, but it doesn't have to be at a specific job. People hear this and think, okay, this all has to be at one job and I just changed jobs and it's an issue. That's usually not a problem. Really what they want to see is they want to see that 2-year history. It doesn't have to be at one job. They want to see just 2 years history of stable employment. And job changes are fine, usually as long as they're within the same field. Okay, if you're switching to a completely different field, usually they're going to have to see some length of time at that new job if it's completely different, or they want to see some sort of qualification. Did you go to school for this job, this new position? Do you have a certification for this new position? They want to see something that proves if you're going from graphic design to nursing that you have the qualifications to stay in that job for the foreseeable future. Also, school or retirement counts. So, when you hear employment, you can be retired and still get an FHA loan, but your employment is just going to be that you're retired. Okay. School also counts for that. So if you just recently graduated college, you can still get a loan because the school counts towards your employment history. FHA does have a pretty strong rule that says if you have a 6-month job gap, then it's required that you have a minimum 6 months at a new job to qualify. Okay, so some income considerations. Non-taxable income, so for example, disability or Social Security, that can be grossed up by 115%. So basically what ends up happening with mortgages is that lenders use your gross income, that's your pre-tax income. And so for non-taxable income, they basically have to act like there's tax on it. So this is really beneficial for you. So if you're making $2,500, for instance, in disability income, that would be multiplied by 1.15%. So we could actually use $2,875 per month instead of $2,500 per month to qualify you on that loan. So it makes it a little bit easier to qualify if you have non-taxable income because we can bump it up just a little bit. There's also no income limits on FHA loans. Your eligibility for a loan depends on what's called your debt to income ratio, which I'll cover a lot more in depth in an upcoming slide. For self-employed people, a 2-year average of tax returns is used to calculate income. Now, keep in mind, your business is not buying a house. You are. So the income that's used when you're self-employed is not your business's gross revenue. It's going to be the profit that you get as the owner of that company. Okay, so it doesn't mean it's just your bottom line profit from the business. Think of it as what money flows to you. That generally is going to be the amount that we can use to qualify you for a mortgage. So things like business use of home expenses, that's an update that can now be added back when calculating qualifying income. So that's a Schedule C deduction. So basically some expenses, things like depreciation, those can actually be added back into your income. But if you have a ton of write-offs, it can be really difficult to get a mortgage with FHA. Just keep that in mind because again, it's the on paper, the money that flows to you, that often is what we can use to get you approved for a mortgage. And so if you have more questions about that, just reach out to us, whenthehouseyouLove.com, and we can help run through those calculations. We can take a look at your tax returns. And what we do is we plug them into a calculator because all of the calculations of tax returns are really difficult to do. And so it's not something you can just do right up here in your head. We have a calculator that does all of that. And so we can take a look at that for you if you'd like. So what you can also do with FHA, this little quirk here is you can use roommate income. FHA calls this border income. So what this does, it helps you increase the qualifying income so you can afford the home. You can get that approval. Now the requirements here are a little bit tricky. You need 12 months of documented history of receiving rental payments from a roommate at the same address. So you and the roommate have to be at the same address, 12 months documented history of you receiving rental income from them. Also, a signed statement of intent to continue boarding is needed. So basically, this situation is going to apply to a very small amount of people. But if you're currently living with a roommate and you're the one making all of those rental payments, and then you're going to buy a home and they're going to come live with you, in that situation, you can use that income to help you qualify for a mortgage. All right, so let's talk more about affordability and budgeting and debt to income ratios. So this is ultimately how lenders determine how much of a loan you can get. A lot of people, I think, just feel like it's a magic, it's a number pulled out of a magic hat, but really it's just formulas that lenders use to see how much of a loan they'll approve you for. So your affordability is going to be based on a percentage of your gross monthly income. Again, gross just means it's your before tax income. These are the general rules here. Okay, so these are the maximums that we tend to see on FHA. Up to 46.99% of your gross monthly income can go to your mortgage payment. That is crazy high. Most people aren't going to run into a number that's that high. Usually people are going to stick to around 30% of their gross income going towards a mortgage payment, but FHA allows all the way up to just under 47%. But this is why it can be such an attractive option for some people, because maybe it's just you on the loan, but you also live with somebody else who helps pay that mortgage. Because you have such a high ability to take on a mortgage payment with something like FHA, it can be a really attractive option because the approval is often easier than other types of loans. And then you can go up to just under 57% of your income for your total monthly debt. So this is your mortgage plus any other minimum monthly debt payments that you have on things like credit cards, student loans, things like that. Now, keep in mind here that these are the maximums that we see, but not all people can get approved for this much. This is where AUS comes in. Basically, what's going to happen is the lower your credit score is, those numbers are going to lower. The maximum that you'll get approved for is going to lower. This is for kind of the maximums that we see. These are for the most qualified people if the underwriting system approves them. Okay, so there's really high flexibility in how lenders assess affordability. But keep in mind, just because you can qualify for a higher loan doesn't mean that you should take it. You really need to stay within a budget that feels comfortable for you. A lender is not your financial advisor. And what most loan officers are going to do is they're going to show you like what the maximum approval amount is for you. But please only take on what's comfortable for you. Your lender shouldn't be the one telling you this is what's comfortable for you. They're going to tell you the maximum, and then they can help show you price ranges within that maximum. Okay, a super overlooked piece of FHA loans that honestly a lot of loan officers forget about is what's called community property. So if you are buying a home in one of these community property states here listed on this map, if you have a spouse, their debts will be included on the FHA loan qualification even if they're not on the loan, okay? Because in these community property states, basically community property rules basically to say that spouses share liability of debt with each other. So lenders have to take that into account. So if you're applying for a loan by yourself, but you have a spouse, their debts are going to have to be included in the debt to income ratio as well. That can really limit the amount of mortgage that you can get. So if you want to, you can go to a conventional loan to avoid these community property rules, but FHA has to follow these rules. So it's something to keep in mind. What you can do in that instance, if you add on your spouse's debts and you're not able to qualify for as much as you want to, you can see, okay, can you add them on to the loan and include their income as well to help offset that. But talk to your loan officer about some strategies there. It's just something to keep in mind because it can really trip up people who are buying homes in these states. FHA allows co-borrowers. So basically on a loan, you have a borrower, the main person getting the loan, and then a co-borrower. Now, a lot of people think that it's like a co-borrower is just like sitting in the background silent. Most of the time with most loans, a borrower and a co-borrower are effectively the same level of responsibility. It's not like one person is more responsible than the other. You both have equal responsibility. The mortgage is going to be on both of your credit reports. If there's a late payment, it gets hit on both of your credit reports. So equal responsibility between a borrower and a co-borrower. So what a lot of people will do is they might buy a home with their partner, and so there'll be a borrower and co-borrower. But what you can also do is add what's called a non-occupying co-borrower. So this might be, let's say you're looking at buying a home by yourself. A really practical example. I worked with a guy who was self-employed. He wrote a ton off on his taxes. So on paper, it looked like he didn't make that much money. So on his own, getting the mortgage, he couldn't qualify for the house that he wanted. However, he added his dad on to the mortgage. So the dad is not going to live in the property, so it's non-occupying. And then he's going to be a co-borrower on the loan. So he's a non-occupying co-borrower. And so FHA says that If your non-occupying co-borrower is a relative, so a parent, child, sibling, grandparent, aunt, uncle, in-laws, then you still can do 3.5% down. However, if it's not a relative, then FHA is going to require 25% down. So it's something to keep in mind. A non-occupying co-borrower can help you qualify for that home. Again, think of someone maybe that has, often I've seen situations like a child, an adult child, maybe they're 25, they have limited credit history or limited income on paper, and the parents are going to help them with the mortgage by being a co-borrower. That's perfectly fine. Very typical example. And so that's something that you can use if you need help with that mortgage approval. Now, the debt to income math can be really tricky. So I have a Google sheet that does all of this for you, all the math that shows you what you can qualify for and runs through how all the math works with debt to income ratios, shows you different affordability theories, and even shows things like some hidden costs that maybe you're just not counting on. And so you can use that calculator if you go to winthehouseyoulove.com/max price. You can use that, and that's a really great starting point to see what your budget is and then an idea of how much you could get approved for with a mortgage. Now, property types for FHA, you can buy a single family home, you can buy a condo, a townhouse, a manufactured home, a modular home. Keep in mind, I didn't say mobile. FHA is going to require that the home is permanently attached to the land, okay? You can also buy a 2 to 4 unit property, and that's allowed with only 3.5% down. Now, something to keep in mind here is that 3 to 4 unit properties with FHA can be really difficult with only 3.5% down because of what's called a self-sufficiency test, which I'll get to a bit later in this video. And then also accessory dwelling unit income is allowed, and it can be used to help you qualify. So ADUs aren't common in all of the US, but in some of the US, basically an ADU is like a tiny house in your backyard. That's an ADU, right? So if you rent that out, you can actually use that income to help you qualify for a loan. Okay, some general property requirements here. FHA is going to require that everything be a primary residence. You cannot buy an investment property with an FHA loan. So it means you're going to need to say that you're going to occupy the home, or you intend to occupy the home for at least a year. Now, when I say this, you can sell at any time. So you can buy the home and then a month later sell. That's not a problem at all. But if you're going to buy the home and then you want to rent it out in the future, you need to live in it as your primary residence for at least a year. If you try to rent it out without refinancing it into an investment property within a year, you could run into what's called occupancy fraud, which you don't want to do. They investigate it. They know people try to game the system, and they will look into it. So you don't want to commit occupancy fraud. So if you're going to intend to rent out the property without having to refinance into an investment loan, then you need to be in the home for at least 1 year. Okay, 2 to 4 unit properties are allowed. And what you also want to keep in mind is you want to work with the right real estate agent who can help you find FHA eligible properties, familiar with the FHA process, and can help you negotiate effectively. Because FHA can have some quirks, it's really something you want to keep in mind, especially around the property eligibility, because I'll get into a little bit more of the property requirements. So often I see agents who just aren't familiar with FHA, and they'll just write an offer. You're putting earnest money down and having some stake in the deal, all for there to be issues with the property, and it just becomes so frustrating to deal with. So work with an agent, ask your agent, hey, are you familiar with FHA and some of the property requirements? Can really give you a head start when you're looking at some homes. So some occupancy rules here is the move-in deadline. So let's say you buy the home, you close on it, you need to move in within 60 days of closing. Okay, the minimum time that you have to be in the home before renting it out and not refinancing into an investment loan is 1 year. Now, let's say that you bought the home, 6 months goes by, and you say, you know what, I need to move somewhere else. I'm going to rent this out. What you have to do is refinance the loan into a conventional investment loan. So it's something you need to be mindful of, that those requirements can be a little bit more strict. And the minimum occupancy time before selling is none. You can sell at any time with an FHA loan. Okay, so condos are allowed with FHA, but they come with a little bit of red tape that can be frustrating to deal with. So the condo association must be approved. Okay, so FHA needs to make sure that it has like the value of the condo is going to be stable, because frankly, a lot of condo associations are run pretty terribly. And so Let's say that the condo association is run terribly and now they can't fix the roof. Well, all of a sudden you're going to have issues if you try to sell that home, or if you default on your loan, the lender's not going to be able to sell that home for you. So that's something that they have to check and make sure that it's actually stable and run well. And so FHA has an approved condo list, and only condos on this list qualify for FHA loans. If your condo that you're wanting to buy is not on this list, FHA allows what's called a single unit approval, where basically they're going to require a bunch of documentation about the condo association to see if they can effectively add it on to the approved condo list. This has about a 50% success rate. So keep that in mind. It's really difficult to do, and frankly, I just don't find it that worthwhile for a lot of buyers if it's not already on that approved condo list. So keep that in mind. And then also, HUD reports that only 6.5% of all condos qualify for FHA financing. And really, I know that these rules can be feel like they're in the way, but they really are there to protect you. The rules that FHA has in place really are set up to make sure that you don't get burned by a condo association that's mismanaged, because if something happens in the future and they don't have reserves available, or they don't have the ability to repair something like a roof, then you get put in some hot water if you're buying that condo. So FHA is really big on property condition. So what's going to happen is your lender is going to have an FHA certified appraiser come out and appraise the home. And they're basically trying to see that the value of the home matches what you're buying the home for. Also, FHA is really adamant about health and safety. They want to make sure that that home is going to be fine for you to live in. It's habitable, it's safe. And so that's something that you really need to keep in mind. FHA really wants a kind of move-in ready type home. That doesn't mean it has to be like HGTV on the inside, but certainly things can't be falling apart and broken and in complete disrepair to be able to get an FHA loan. Also, FHA is worried about things being structurally sound, move-in ready, and it's stricter than conventional loans due to its government-backed financing. So there's just stronger requirements on FHA than there are something like a conventional loan. So some things that an appraiser is going to look for, or some of the things that you want to be mindful of with this appraisal, is number one, a lot of people don't realize this, but there's what's called an amendatory clause on all FHA loans. Basically what this does is it ensures the buyer isn't forced to proceed if the appraisal is lower than the purchase price. So what's going to happen is you're going to write an offer on a home, and even if in that offer you say, if the appraisal comes in short, we'll cover the difference. The amendatory clause is going to be signed after that part of the contract. And so the amendatory clause is going to have the main authority in the contract around the appraisal. So basically what it's saying, if you go to buy a $300,000 home, and let's say that the appraisal comes in at $280,000. Okay, well, there's a $20,000 gap. So either the seller needs to come down $20,000, you need to bring $20,000 extra to closing, or you two meet in the middle somewhere. The seller comes down $10,000 in price and you bring $10,000 extra. So if the seller and the buyer can't agree on what they're going to do there, then the amendatory clause says that you as a buyer are allowed to leave without your earnest money being taken by the seller. So it adds that protection there. A lot of people just, I guess, don't even read those documents, but it gives you that protection. No matter what the contract says, since the amendatory clause is signed after the contract, it's an FHA protection that you have that is going to supersede anything in your contract that says you have some sort of appraisal gap or whatever, because the date of the signing of the amendatory clause is after that contract. It's going to override it, okay? You cannot close an FHA loan without this amendatory clause protection. The roof needs to have 2 years of remaining life. Electrical, you don't want any exposed wiring. I can't tell you the amount of times an appraiser has gone through a house and then they'll just come back and be like, there's exposed wiring. You have to replace it or you have to fix it. And then they have to schedule another appraisal, and then it's going to cost more money for them to come back out. There shouldn't be exposed wiring anyway. It's really not that hard to go through and have those all capped. Appliances must be fully operational. Handrails are required if it's a safety risk. And then also water drainage. You don't want any standing water near the foundation. So these are things that you want to be mindful of. If you're buying a home, making sure that, before you make an offer on a home, keep in mind some of these things. But then also, if you make an offer and that gets accepted by a seller before an appraiser comes out, you just want to make sure, okay, none of these really basic things are issues. That way you can address them before the appraiser actually goes through and makes an inspection. Okay, attic access is required for an inspection. So if the seller has a bunch of stuff like preventing them from getting to the attic, an appraiser will basically say, I'm gonna have to come back again once this is cleared. A pest inspection is only needed if there's evidence of past or current infestation. So think of things like termites. Paint requirements. So if the home is built before 1978, there cannot be chipped or peeling paint inside or outside. For homes built after 1978, the exterior defective paint exposing subsurface must be repaired. All other defective paint is fine. And then for windows, broken glass needs to be replaced, but cracked glass is acceptable. Okay, FHA has some rehab options. So we've talked about like a normal FHA loan, you can't buy a home that's in disrepair. However, if you get a FHA rehab loan, it's a subtype of an FHA loan, then you can buy a home that needs some work done. And basically what ends up happening is you're financing both the purchase of the home and then also the rehab costs at the same time. All right, so keep in mind that for this rehab type work, you're going to need a contractor or somebody licensed to do this work. I know there are a lot of people out there that want to do it themselves, and I believe that you can do it, but FHA doesn't allow it. They need somebody who's an independent, licensed to be able to do the work on this. They're not just going to give you a lump sum of cash and say, go have fun. Okay, so there's what's called a 203K standard for major repairs and a 203K limited for smaller repairs. So 203K standard is going to be a $5,000 minimum loan amount with no maximum. It's going to cover structural repairs, or it can recover up to structural repairs, and it's required for projects over $35,000. A limited is a loan amount up to $35,000 with no minimum, but you can't do any sort of structural repairs. So keep that in mind. The limited is a little bit easier to do. The standard is a little bit more difficult to do just because of the nature and the cost of it. Okay, let's talk about house hacking. A lot of people use FHA to house hack, and basically house hacking is just kind of this umbrella term for using an FHA loan or maybe any other type of loan in a non-traditional way. So a more traditional way is you're gonna buy a home as your primary residence and that's it. But to use it in a non-traditional way, there's a couple things that you can do. One is that you could buy a 2 to 4 unit property with just 3.5% down, and then you can live in one of the units and rent out the other ones. So this is a method a lot of people do to basically have other people pay for your mortgage payment. Because if you have, let's say 4 units, you live in one, rent out the other 3. The profit from those 3 units can help pay off the total mortgage, and you're able to do that with just 3.5% down. Okay, so what's nice about that is you can use 75% of the projected rental income to help you qualify for that mortgage. So the reason why it's 75% is because FHA basically assumes there's going to be 25% in there for vacancy that you kind of need to calculate for. So they're going to use 75% of projected rental income. Now, what's you need to keep in mind about FHA is they have what's called a self-sufficiency test. So for 3 to 4 unit properties, this says 70 here, but this is going to be 75% of future rental income must exceed the total mortgage payment. Okay, so keep that in mind. So like if your mortgage payment is $2,000, then you need to be able to have rental income from the other units that is going to exceed that. Like 70% of that needs to match what your mortgage payment is or higher. So that can be difficult in a lot of cases. And so often for 3 to 4 unit properties, it can be difficult to do just 3.5% down. Often you have to raise the down payment to be able to meet the self-sufficiency test. And then also with 3 to 4 unit properties, you're often needing 3+ months of reserves. So after you pay your down payment and closing costs, basically if your mortgage payment is, let's say $2,000 a month, you would need $6,000 left over in your bank account to prove that you have some extra padding for expenses in the future. Another option that you can do with house hacking is a move-up strategy. So this is really common with a lot of people because FHA requires that you're going to be in the home for a year before you choose to rent it out as an investment property. So what a lot of people will do is they'll buy their first home with FHA. They'll do 3.5% down. They'll buy it. They'll live in there for maybe a year or two. And then what they'll do is they'll go buy a second property that they're going to live in, but they'll rent out this first FHA loan. What's nice about that is you get to hold on to that loan. You don't have to refinance it into an investment loan because investment mortgages are going to be more expensive, have a higher rate, and a little bit more requirements. And so it allows you to kind of get that first investment property with a really low rate loan, which is a primary residence loan. Also, FHA is nice because it can be assumed. So a future buyer can take over your FHA loan and interest rate. So this isn't super common, but basically when you buy a home with FHA, you could actually say in the future that you're going to sell it, but you can actually have a buyer take over your current mortgage. So if your rate is lower than what the market rate is at that time, it can be really attractive for a seller to take that over. And because they're getting a lower rate, you may be able to negotiate a higher price for that home because it's coming with a lower rate, and that's going to be more attractive to a buyer. Another strategy I like to call the bridge strategy. And so this is basically because so many people think that to buy a home, they need 20% down, they need an 800 credit score, and that their life needs to be pristine. It's just simply not true. FHA allows so much flexibility that so many people can get approved for FHA. And so what I would suggest for a lot of people is, okay, you want to get into the real estate world because you know real estate helps you build wealth long-term over time, but working on getting 20% down and building your credit is going to take you maybe a few years to get to that point. And so what this bridge strategy does is I want you to think about FHA as a bridge to get to where you want to go. Okay, so you would use an FHA loan to secure the home. So maybe you only have 3.5% down right now. Maybe you have a credit score that's 620. Okay, so you're using FHA to be able to buy the home, to secure it. While you're in that home, you're building equity that you're paying into the mortgage, right? Because if you're renting, you don't build any equity. All that money just goes to your landlord. When you own a home, so a portion of that payment is going into paying down that balance. And then you're also getting appreciation, right? Historical appreciation is around 4 to 5% per year nationally. And so, compared to renting, with renting, your mortgage payment is increasing often annually as the landlord increases that payment. But when you own a home, your home value is increasing over time. And so you're able to build equity and appreciation while you own that home. And then while you're in the home, you want to work on things like your credit score, income stability, and debt to income ratio. That way, you secured the home, and then over time, you're working on all of those other areas to get you into a loan with a better interest rate. Maybe because you had a lower credit score, you get the FHA loan, work on your credit, and then you can either refinance into a conventional loan with a lower rate, or when you buy your next property, if you want to do that in the future, you can get better terms and an easier approval in the future as well. So basically, I just want to point this out because you don't have to everything in your life doesn't have to be perfect and glowing to be able to buy a home and to be able to get the benefits of home ownership. You can do that now while also working on those other aspects like your credit score to get better terms in the future while still being able to buy a home now. So after you buy a home, you may be looking at some refinance options in the future. Refinancing is usually common when you have the market rate. Let's say right now the market rate is 7%. So after you buy a home over time, let's say that the average market rate goes down to 6% or 5.5%. So the market rate's now lower. What you can do is refinance into a lower rate loan. And so FHA is actually really cool because conventional loans don't have this. They don't have what's called a streamlined refinance. So FHA has a streamlined refinance. And basically what it does is after 6 months, if the market rate lowers, you're able to do a refinance, and it doesn't require you to do the whole underwriting process again, right? So most of this video, we've talked about the underwriting process and how to qualify. They're not going to check your income, credit. You don't have to do this big full approval, right? An appraisal isn't often required. And so a streamlined refinance is really nice. It makes it really easy. Really what they want to see is that you've been making on-time payments on your mortgage. As long as that's the case, you're usually eligible for that streamlined refinance into a lower market rate. Another option too is going from a FHA to conventional refinance. So this is ideal if you bought the home, you've worked on your credit a bunch and it's improved a lot, you can refinance into conventional. What's also nice there is it can remove your mortgage insurance premium. If you have 20% equity in refinance to conventional, you won't have any mortgage insurance at all on that conventional loan. Another option is a cash out refinance. This is where you would take some of that equity in your home and actually pull it out as a lump sum of cash. People often do this to help pay down high interest debts. That's a really common strategy. Now, this requires at least 20% equity in your home to begin doing this. So it's something to be mindful of. It can take quite a bit of equity to be able to pull out a cash out refinance. Okay, so the success rate and seller perception. To sellers, FHA can be less attractive than conventional. Yes, it does have some stricter appraisal requirements than conventional. Unfortunately, a lot of sellers feel like FHA buyers are like not qualified, which is so crazy because FHA is more flexible than conventional. And so what I think a lot of sellers don't realize, like, and most people don't realize unless you work in the mortgage world, is that someone who has a conventional loan, often if someone's kind of like at the edge of qualifying for a conventional loan, it can be really difficult. They might just like, it might be this balancing act of, are they going to get approved if their insurance might come in higher and all of a sudden they won't get approved for a mortgage. But FHA has a lot more flexibility. And so FHA should be a better option for sellers in terms of thinking about a buyer's financial ability. Unfortunately, sellers get a little bit too, in my opinion, a little too in the weeds of, it's this weird like, oh, you had an FHA loan? Well, you must not have great credit, so you shouldn't buy my house. It's just so silly. I don't get it. It doesn't make sense. All a seller has to do is talk to your loan officer or have your loan officer call the seller and say, hey, we've checked everything. Everything's good to go. This FHA loan is going to be great for this buyer. Like, that's all that they need to hear to have confidence in your loan. So if you're running into that issue where you're getting an FHA loan and you're losing some bids against other buyers, ask your loan officer, hey, can you just call the selling agent on this next offer? That way you can help strengthen that everything's going to be good to go with this FHA loan. And FHA is going to be more accepted in more of a buyer's market. So if you're in a really hot market with a lot of competition, conventional, frankly, is just going to look better to sellers. But as competition declines, FHA buyers can still have a good chance of buying. Now, because the perception of FHA tends to be, lower than conventional, and hear me out here, like it's not, sellers aren't like, oh, FHA is all the way down here and conventional offers all the way here. It really is kind of like conventional offer, FHA, like it's just a tier below. But what you want to do is just keep in mind of that, of how sellers perceive FHA to make your offer stand out. So some things you want to keep in mind that if you're coming in with an FHA offer, I would offer a fair price. I know a lot of people they step in the real estate market and they're like, I'm going to get one up on the seller. Just offer a fair price because other people are going to try to get that home as well. And so if you're lowballing and then someone else comes in with a conventional offer and it's more than you're asking, more than you're offering, the seller's going to go with that. It's this kind of weird thing I feel like people run into where they're like, we love this house. This is our dream house. This is everything we've ever wanted. And we're also going to try to undercut them by $50,000. Those two don't mix. If this is the home, you're like, I love this. This meets everything. We've been looking for months and we couldn't find anything, but this is the one. Make your offer reflect how much interest you have in that home. So I see so many people, they just lowball and wonder why things aren't working out. You need to offer a fair price, especially if you're coming in with an FHA loan. So talk with your real estate agent about, hey, what would be a fair price? How can we make our offer attractive with our sales price here? Also keep in mind your seller concessions. The more seller concessions you ask for, that's money coming out of the seller's potential profits. So if you ask for a lot of seller concessions, your offer is going to be less attractive. Also shorten the inspection contingency period. So a faster process, a faster closing can make sellers feel more confident that you're going to be, you're going to be treating them fairly through the process. And then also sellers just want to be able to close quicker most of the time. And then also you want to get a strong pre-approval. So well-documented loan can help you negotiate a quicker closing. So for instance, what we do is we can do a fully underwritten pre-approval where we'll get everything put together. That way you can go to a seller and say, hey, we can actually close this quicker than all the other offers that you're seeing because all of the work for the loan was done before you actually made an offer on that home. So the best way to do this is you can apply with our team. Simply go to winthehouseyoulove.com. And then what will happen is you'll just fill out a little bit of info and our team will reach out to you to get that application started. Then you'll see your FHA quote and the loan options that you have. It will also show you the max purchase price that you can go for. And then we can also help you take a look at what quotes actually fit your budget and the price range that you want to stick in. Then what you can do is you can shop for your home, had a little typo there, and then you'll write an offer and we'll help you close the loan. So we'd love to help you. We work in 49 states, so all states except for New York, and you can go to winthehouseyoulove.com to get started on FHA. Or if you're like, I don't even know what type of loan I want to go for, we can help find the one that fits you the best.